Now, of course, just taking you into a case study here, I'm just wanting to show you how you can actually leverage off some of your existing assets to invest into the share market and further accelerate your wealth. So here we have Bill and Jane. They own a principal residence worth $1 million. They're very fortunate. The kids are off their hands, school fees are paid, and they're now debt-free. The mortgage is paid off too. They have a savings capacity now of $30,000 per annum, and they're looking towards retirement. So their objectives are obviously wealth creation, obtaining some diversification, and maintaining a strategy that's flexible and that's something that they can remain in control of. So the strategy here is to borrow $300,000 using their property as security and investing that money into the Australian share market. The time frame for their investment is 10 years, and they're adding their additional savings to the portfolio on an annual basis. Now, in terms of the returns, and when it comes to when a Hewison advisor provides a projection, we feel a responsibility to be rather conservative, and which is completely fair enough. But in demonstrating this particular case study, I have used that 16.5% return that I showed you from the All Ordinaries Index, purely because, as I said before, that is what it is. So what this, effectively what this graph is showing, that with that $300,000 borrowing and reinvesting the $30,000 on an annual basis, after 10 years in the repayment of that $300,000, Bill and Jane are going to wind up with a portfolio that's worth around about $1 million, which is going to be a huge benefit to them to provide them with an income in retirement. So in summary, ladies and gentlemen, owning Australian shares represents an opportunity to invest in some of Australia's most well-run companies. It's a liquid asset that allows you to easily unlock value throughout time. Next to zero outgoings, pays great dividends with imputation credits, and over the long term, the return is superior to any other asset class. I rest my case.
When we're comparing returns, and I think Andrew pointed this out quite well, we've got to be really careful about the time frames that we're using to compare. We've had some really great periods with shares and likewise with property. We've also had some really poor times with shares and with property. We've got to compare appropriate time frames. What we've seen this evening is a lot of historical returns. Now, whilst history can show us perhaps cycles, and we can learn from what has happened in the past, but it's not a predictor of the future. And no one that I know owns a crystal ball. I'd like one. And we've got to be very careful about extrapolating historical returns into the future. I don't think I need to labour too much on the issue around tax. Andrew's pointed that out very well, but the after-tax outcome of your investing is most important, and sometimes the strategies that are implemented around where to house investments are actually more important than what the actual investment is. When you're looking at investing, it's pretty important to make sure you choose an investment that's appropriate to your circumstances. Sure, as Glenn pointed out, you can borrow a lot of money if you're going to invest in property. The banks will give it to you. But the question is that really a good idea? You need to be able to repay the loan, meet the interest costs, and you've got to consider such issues as interest rate rises, a change in employment or loss of employment, or even the loss of tenants if you have a property. If you're investing in shares, I think the graph that Andrew showed with over 110 years, that little squiggly blue line, very clearly showed the volatility that you'll have to cope with when you're investing in shares. That is a fact of life of being a share investor, that your share investments will go up and they will go down. But the long-term figures, as we've seen over a very long period of time, share investment, as does property investment, will provide you with an increase in your wealth. In relation to the case studies, what we've seen presented is a very good indication of what happens when you borrow to invest. And borrowing to invest into assets that grow is a great way to increase your wealth. But if the assets fall in value, your losses are magnified. And that is something that you have to be aware of when you're borrowing to invest, and certainly a risk that you must be very, I suppose, able to cope with. And finally, diversification. Andrew's pointed out you can diversify with shares. Ideally, and from our perspective, we would like to see both asset classes in an investment portfolio. It's our belief that both property and shares work very well together to produce a great outcome for investors. And so, from that perspective, a clear winner? Well, I don't think there is a clear winner. It depends on your circumstances, and it is a bit of a cop-out, I think, but the reality is both shares and property can be used to increase your wealth.